Ladies and gentlemen, thank you for standing by. Welcome to the Pension Fund Q&A conference call. At this time, all participants are in listen-only mode. Later, we will conduct a question-and-answer session. Instructions will be given at that time. Now I'd like to turn the conference over to your host, Mr. Jim Hamlin. Please go ahead.
Thank you. Hello, everyone. For the next hour or so, I will be your host for this question-and-answer session designed to keep you informed about the pension fund and to answer as best we can any question you might have. Our last call in program was 6 months ago, and much has occurred since then. I hope you will find this session informative and helpful. As is our custom, several of my colleagues are sitting with me today, who I will call on in the event they may best be prepared to answer your question. Included in this group of folks who are sitting with me are Duncan Draper, our Vice President, Chief Financial Officer, and Treasurer; David Stone, our Vice President, Chief Investment Officer; Michael Porter, Director of Health Services; Eugene Fisher, Vice President for Employer Services; and Sandra Michael Bauer, our Vice President for Member Services. The session is being recorded and will be posted on our website early next week. So if we run out of time and your question is not answered but you want to ask a question, please join us later today at 7 p.m. for our second call-in session, or on Thursday at 4 p.m. Both of those are Eastern Daylight Time. If you have specific questions or questions you are not able to ask today, feel free to call us or email us at pfcc1@pensionfund.org. We'll open for questions in just a moment, but I would like to make a few comments. After nearly 2 years of preparation, on June 1, the pension fund implemented a new data system designed to give staff additional tools to which would help us serve you more effectively and to provide participants with online access to accounts and employers online access to manage employee participation. The new system generally functioned well throughout the month, but as the end of the month approached, we discovered a fatal flaw in the new pension payment process that caused us to revert to the old system and use June 1 pension payments so that pensioners would have funds in their accounts on July 1 as expected. The plan was to provide the correct pension amount on July 3, coupled with electronic recovery of the July 1 transaction. The plan seemed simple enough, but following implementation of it, we discovered additional problems related to the tax withholding, health care payments, and some account numbers. The best-laid plans did not fully remediate the initial problems and indeed caused additional unintended pensioner impacts. For all of these issues and for any expense that you incurred, we humbly apologize. August 1 payments went much more smoothly, although not completely without challenge. Actions to resolve residual issues with both July 1 and August 1 transactions are nearly complete, and we anticipate that September payments will function accurately. If you tried after early July, if you tried to call or email our offices and found our responsiveness lacking, I apologize. With more than 6,000 pensioners receiving pension benefits affected by the July 1 challenges, our call center of 5 incredibly talented and committed colleagues were simply overwhelmed by the volume of emails and calls. They, and indeed most of our staff, have worked many extra hours these past couple of months in our effort to serve everyone. Quarterly statements were also delayed, and they were sent out for most participants in early August. I hope you find the combined account format more efficient and cost-effective. Early feedback has been most favorable, and we continue to tweak the report to further streamline the process for future reporting periods. I do want to share that with you that effective with the second quarter reporting, the pension fund implemented daily compounding on all TDRA, BA, and IRA accounts. This calculation process will marginally enhance further the return that you receive on your accounts. Interest rates for the last quarter of the year will be announced on or before September 18. Watch for the announcement on our website. Some of you may have your health care coverage through Churchwide Health Care. Rates for 2014 will be announced in early September, and while they have not been finalized, I can say that we expect rates for Medicare secondary care plans to remain about the same as in 2013. Active plans should see single-digit increases, and of course, if one has hit one of those magic birthdays that ends in 5 or 0 this year, your actual rate of increase will be greater due to the age banding of rates. We presently do not anticipate significant change in church-wide health care program for 2014 as a result of the Affordable Care Act. Through the first 6 months of the year, Pension Fund had good investment returns and outperformed the benchmarks against which it evaluates its performance. It's too early to extrapolate or forecast what that may mean for consideration of special apportionment and good experience credit next year. Likely, one can anticipate that investment markets will remain choppy for the balance of this year. But given the continued slow progress in the economy, I personally expect that markets will remain fairly strong at year-end. Well, when we announced this call-in section, we invited folks to send in their questions. We have a few that we received, and I will intersperse those along with the questions you have to ask. I do want to remind you that this is a nationwide call-in program, that if you have any particular issues about your account or particularly about July 1 or August 1 situations, please email us or call us directly. This is not the venue that we would want to have that kind of public discussion of your personal accounts. So with that, operator, let's open for our first question.
And at this time, if you'd like to ask a question, please press star, then 1 on your touch-tone phone. You'll hear a tone indicating you have been placed in queue. A voice prompt on your phone line will indicate when your line has been opened. You may remove yourself from queue at any time by pressing the star key followed by the digit 2. If you're using a speakerphone, please pick up the handset before pressing the corresponding digits. Once again, that's star 1 to ask a question. And we'll go to our first questioner.
Hello?
Hello. If you state your name and where you're from, please.
Yes, this is John Walker in Bonner Springs, Kansas, and retired pastor.
Yes.
And I have a question about our health care plan. It has to do with I'm active on the board of the YMCA here, and many of our seniors are able to get the Silver Sneakers program, which is an active program for seniors that improves your health through exercise. And I've inquired, and so far I've not found that we have anything like that included with our health care, and I would certainly recommend it and would like to know if that's something that could be offered. Thank you.
I'm going to ask Michael Porter to respond.
Well, the Silver Sneakers program is a program through the Y that's offered, through each local chapter of the Y. We have looked at different wellness plans, not only for our retirees but for our active members. But the problem that church plans run into is that we're everywhere, and we're not in one central location. So we will continue to look for opportunities to encourage wellness amongst our actives and our retirees, but at this point we have not found a plan to match the needs of where our folks are located. And that's a challenge not only for this denomination, but for all denominations as well.
I might add that the challenge for having people dispersed is a matter of compliance. That it's much easier to get people to participate if you have reinforcement of peers and friends that participate locally. And when you are vastly dispersed, it's easy to find other excuses than to follow the plan.
Well, I know other plans offer that, and I just was hopeful that perhaps we could. I understand what you're saying about the difficulties of doing, but I really encourage that kind of thing for all of us in the future.
We will continue looking to try to find a plan that will work.
Thank you.
Thank you, John.
And at this time, there are no other questions in queue. As a reminder, it's star 1 if you'd like to enter the queue. We do have another question now.
Hello?
Yes.
Yes, this is Bill Garrett. I'm in Northern California region. My question is, when I retire, I'm not retired yet, and we start getting the pension, can some of it at least be designated for health insurance coverage? I know you can always have it designated for housing allowance, but can some be designated for premiums?
The answer is yes. You can allocate some of those dollars for premiums. It is not a tax-free designation. In other words, you don't get a deduction from your taxes for that, other than having the medical deduction. You don't exclude those amounts that are paid from your taxable income. Is what I'm trying to say.
Okay, but housing allowance you do.
That's correct.
Okay.
But you certainly can pay your premium through your pension.
Right. Okay. Okay. I didn't know whether that would be a pre-tax situation or not.
No, that cannot be pre-tax.
Interesting. Okay. All right. Thank you.
You're welcome. Thanks for your call.
Mm-hmm.
And at this time, the question queue is empty.
Okay. Well, while we're waiting for another question, I would like to read one that we received by email. And one member asked us to explain our change in philosophy towards our base interest rates for TDRA and BA. I'm going to ask Duncan Draper to respond to that.
Thank you, Jim. First of all, I would say that the high-level philosophy of our base interest rate really has not changed over the years, and that is that we continue to pay interest rates in positive, meaning we never go below zero. What we have done is we have inserted some ranges and those kind of things. I'll talk about that in a second. But I do want to be clear that as a philosophy of how we provide earnings on these funds to our members, that philosophy has stayed intact since the program began, where even in years of decline, when the market is in turmoil, our members still receive positive earnings on their accounts. Shortly after the 2001-2002 recession, staff and the board of directors evaluated our programs, our interest funding programs, such as that Jim described, and felt that the risks that are inherent in those kind of programs, and with the idea of constantly wanting to reinforce the fact that we cover the downside risk for our members in that way, that we needed to establish reserves and accrue those reserves into a higher level. That therefore then precipitated us introducing the concept of some interest rate ranges. I believe up until that time the lowest range of an interest rate was 6%. Those ranges then were changed to 3 to 6%, with the idea of good experience credits and special apportionments supplementing when times were good and reserves were strong, the use of good special apportionments, good experience credits being specifically what enhances the returns for these programs. That would then be available once a year as an evaluation as a point in time based upon our position and our reserves. More recently, as we went through the 2007 and 2009 time frame with that very significant market turmoil that went through, and which we are just now recently fully recovering from, again, the board and the staff evaluated the risk to the model that we try and operate under. We reinforced the concept of the philosophy of continuing to help our members protect against the downside, but again needed to establish a more aggressive posture in ensuring that our reserves were adequate to protect against those kind of downturns that always occur through the markets. It's a question of timing. It's not a question of if, it's a question of when. And therefore, from that, we expanded that range again, and the BA account in particular received a range of 1% to 6%. Now, the rates more recently have been funding at 2% in the BA program, and for that, I would still suggest that given the features of the BA program, and fully acknowledging that many of our members use the BA as a supplement to the retirement program, but the actual features of the BA program, allowing you to have almost instant liquidity and access to those funds, cause that to have that feature causes it to be compared more to a bank savings account or those kinds of instruments. And I think anyone would agree that we have continued to significantly outperform, even when rates were at 1.7%, which I think is the lowest that the BA rates went to. They're currently at 2%. they still are much better than what you would get in this similar type of product at a banking organization. I think in the future, and when we talk about interest rates, not to concern or alert anyone, but we continue as staff and as the board continue to mull over how we see the future and what does that mean to these programs. And I think the reality, I think it was called a few years ago, the new normal. I don't think you hear that term very much anymore, but the reality is there is a new environment going on in the marketplace. Being able to gain the types of investment returns that we saw in the 1990s, as an example, probably they're not likely to happen anytime soon, and we're not going to see those kind of market conditions come back. So I think in the future, market performance will continue to influence where our reserve position is and what we're able to pay on those programs, and that may have some influence again on good experience credits. I know folks who have been in the program for many years always like to refer back to the double-digit types of good experience credits that we were able to provide. I would have to say that those are going to be quite a challenge to be able to deliver those in the future. I won't rule them out because I can't predict the markets, but I can tell you that they would be clearly a challenge. I think the other thing that we should be alert to is the fact of the BA program looking differently than the TDRA and the Roth IRA, that it's not very possible, but it's a possibility that the amount of good experience credits when awarded may vary a little more significantly between those programs in the future as well. So our basic philosophy, I think, is still intact, but we continue to tweak it, and with the idea that we are a long-term provider of services for our members, and sustainability is very critical to what our philosophies are about.
Thank you. Operator?
At this time, the queue is empty. As a reminder, it's star one if you'd like to ask a question. And we do have a question now.
Hello.
Good afternoon.
This is Mike Lee from Cypress, Texas. And just a couple of questions. I heard you in your introductory remarks. They're talking about healthcare rates and that sort of thing for 2014. Mm-hmm. Do you all have any kind of ballpark or whatever about changes coming in 2014 in terms of will you get the same amount of coverage for what you've typically gotten, bang for your buck kind of a thing? You talked about changes, particularly if your birthday ended in a 5 or a 0, I think. Is that correct?
Well, if your birthday hit 5 or 0 this year, the rate of increase of your premiums will be both the change in what I would call the rate table, which will be a single digit, plus the impact of what the table changes are by virtue of age banding. So that's one issue. Okay. But we are not planning any changes in benefits. Okay. In any of the programs for 2014.
Okay. So if it hits 5 or 0 this coming year, you're saying?
No, if you hit it this year, then you would see the rate increase next year.
Okay. So if you're already a 5 or a 0, that's not going to...
That's right. But if you turn next year, it would be the following year that you would be hit by the age band. Okay.
And then on the premium, sir, you said it looks like it's going to be single-digit increase. Is that right?
That's our best guess at this point.
And that will be across the board, no matter what your age level is and that sort of thing?
The rate table itself would be adjusted in that rate.
Okay.
Okay, so, with the same rates.
So you say single. I mean, are you with your crystal ball? Are you looking at like 9% down, that sort of thing, or?
Single digit is less than 10%.
Okay.
And actually, I think it'll be much lower than that.
Okay, very good. Just a couple of questions. This may be too personal for the line here, but I'm not actually retiring from the pension fund. I'm a member by virtue of I've got money in a TDRA and a Roth, but I'm not a part of the pension program. At what point, when I leave ministry, let's say at age 65 or something, can you continue to be involved in the buying Medicare supplement and that sort of thing? My second question is, would my spouse still qualify to be in the health care program because she's under 65? That may be too personal for this line, but can you address that?
I think that's a fairly generic kind of question. Okay, even though it's personal to you.
I guess
Michael?
Yeah. By your participations in the tax-deferred retirement accounts and the Roth IRAs, you certainly qualify to participate in the Medicare secondary plans once you reach age 65. As far as your wife, she is also welcome to continue in the health care plans as long as you are a participant in one of our Medicare secondary plans, providing that I'm making the assumption that you're older than your wife.
Yeah.
In my case, it would be flipped, but but in that case, as long as you participate in our health plans, then she can participate in our health plans as well.
Okay.
That's really the only rule outside of your participation in the tax-deferred plan. That makes you eligible as well.
Okay, so if it's 65 or whatever, I leave ministry and do something secular, that doesn't change that part of the equation.
No, it does not.
Fantastic. Appreciate it very much. Y'all always do a great job. Thanks a lot.
Thank you very much.
Thank you.
Bye-bye.
And at this time, there are no other questions in queue. As a reminder, it's star one if you'd like to ask a question.
Operator, while we're waiting, I'm going to ask Duncan if he will respond to another question that we received. And it simply said, I know that the pension fund has been updating its system and has been talking about providing an online access for members to view account information. Can you give an update on this progress, and when do we plan to roll that out for online portals for members?
Thanks again, Jim. As we stated in our opening comments, the time that we had originally anticipated of stabilizing our system has taken quite a bit longer than we had originally anticipated. Our original timeline of plan had called for somewhere in a 60 to 90-day timeline after we stabilized the system to be able to deliver this online access tool for our members. And it was going to be in a two-part process. We would first roll it out for our individual members, and then there was, to follow that would be for our employers. We also want to have an online capability for the employers. The strategy still stays the same. We're still going to roll it out for the online members, individual members first, followed by the employers. And to that degree, we've made some minor progress towards that end, but as you might imagine, our resources have been fully dedicated towards stabilizing the system and correcting some of the errors that we uncovered as a byproduct of that payroll processing that went on July 1 and the subsequent issues that we found from that. Right now, the actual status is that we have received a first draft, if you will, of what that looks like into our test system, but we are not optimistic at this point that we know, I guess I put it a different way, we know that that's going to take significant work to make that fully featured and available for our members. The other thing we're going to want to do is we're going to go through a pilot stage, which is basically just saying we're going to have a small group of people work and access this system initially as kind of a test or a proof of concept type of process before we roll this out to all of our members. I hesitate to give you an exact date of when this is all going to occur, but I would say that we're in that 60-day timeline, hopefully better than that, but I really am not comfortable at this point publishing a date given we have so much uncertainty in terms of what it's going to take to complete the effort of what we go through, and we don't know what we're going to find when we get into the proof of concept process where we use our piloting process. So we are active in this. We do have resources working on this, but our first priority is to get the system in its current state fully functional and processing without error, so that we can then direct all of our full attention then to that next set of process.
Great. Thank you. Operator, do we have another caller?
At this time, there are no other questions. And we do have a question in queue now. We'll go to our next questioner.
Thank you. Chuck Babcock, retired minister. I'm wondering, what problems you anticipate, if any, when the Medical Health Act Obamacare starts to come in next year?
I think there's some interesting challenges that are, at this point, are pretty much unknown, Chuck. One, of course, has to do with the subsidies that are available for people who participate in the exchanges. If pastors are sent to the exchanges and buy their health insurance there to get the subsidies, they cannot participate in church-wide health care at this point. That would require some change of law, and getting anything through Congress right now is virtually impossible. So that's the biggest issue that we see. We think that there will be. I think there are a fair number of pastors who would financially qualify for the subsidies if their church chooses to move them in that direction. So I could see some congregations forcing the issue for some pastors.
But for those that are retired, what do you see?
No change on retirees.
Okay.
The Affordable Care Act primarily addresses active folks because Medicare is already in place.
Okay. Thank you.
Okay. Thank you.
And at this time, there are no other questions. As a reminder, it's star one if you'd like to ask a question.
Operator, while we're waiting, I'll throw in another question that we received. This was about the retirement process, and one person asked, which is the better option? And he wrote, should I retire at age 65, begin my pension fund benefits, at age 66 when I can receive full Social Security, or stay on a few years more? And I think the question was, what are the implications of each? If you are at a point where you will turn 65 this year, you cannot receive your full Social Security. You'll be 1 year short. So you could get full pension fund benefits, but reduced Social Security. If you stay on to age 66, you would get full Social Security, plus pension fund full benefits, plus 1 year worth of actuarial adjustment, or a 6% increase above that. If you continue to work, it's 0.5% increase in your pension for each month after age 65. So if you work past 66, you would continue to participate in the pension plan, pay dues, and then when you retire, you would have both the benefit of the increased credits as well as the actuarial adjustment of 0.5% for each month. So which is better? It's really up to the individual to determine in their own financial situation and life situation which is the better call. Any one of them will work, I'm sure, but it's really up to the individual. You do need to understand the implications of each, however. Operator, do we have any other questioners?
Currently, there are no other questions.
Let's wait another minute or so, and if not, then we will sign off.
And as a reminder, it's star one if you'd like to ask a question. And we do have another question now.
This is Dr. Von Hansen in Cherokee, Oklahoma.
How are you, sir?
I don't have a question, but I want to thank you for this kind of service. I probably will come on at 7 if I'm not called to do something else and listen some more. Thank you very much.
Thank you.
And once again, that's star 1 to ask a question.
Operator, let me make a final comment and then we can sign off. I want to thank all of you who have offered questions and those of you who have been patient listeners. I trust we have responded in a manner that has been helpful. Our goal is always to care for the resources that have been entrusted to us in a prudent and thoughtful manner, taking care to address the unique requirements and risks associated with each program. We take great satisfaction that during the conversion to a new data system, your account balances were never in question. Transaction and reporting capacity has been the challenge, one that we continue in our efforts to fully resolve. Throughout this process, no one has lost a penny of account value. Know that all of us, staff and directors alike, will continue to focus our energy towards maintaining the pension fund's financial strength, even as we seek ways to serve more effectively and broadly within the life of the church. We thank you for the privilege of serving you and for your interest today. We will schedule another forum when we believe we have important information to share. Until then, please email or phone us with any further questions you may have. It is our great honor to serve you. Good day.
And that concludes our conference for today. Thank you for your participation and for using AT&T teleconference service. You may now disconnect.